Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. In Australia today, we saw third quarter GDP come out at up 0.6%. A big drop from the 0.9% of the previous quarter, but still a positive. Nevertheless, this quarter, Q4, Q1, Q2, and Q3 of 2023 are all at risk of being negative quarters. In the third quarter, we saw households really begin to pull back, and I expect to see more of that as the news has gotten much worse since the state of the third quarter for the Australian economy in particular. So going forward, also imports were very strong, so net trade detracted a little bit from the GDP number, but that probably won't be the case in Q4, Q1, so that will be a slight positive for the GDP number because there's been a lot of catch up on motor vehicles and things due to the previous supply chain disruption. So Australia's economy is slowing, certainly a little bit below consensus. People were expecting it to slow, but not as much. And I think the actual economy is probably in worse shape than those numbers suggest, but that's because that's my view. But I do think we can expect the real economy to underperform the economists' expectations going forward. Remember last year I said this year could be a slow year for Australia, and into 23 risking a surprise recession. I haven't changed that view. You might also recall at the end of last year I was saying in 2022 the US would immediately have a recession, and it did in Q1, Q2, and in fact for the first three quarters of 2022, the US economy has only expanded by 0.4%. That's just a terrible economic outcome. Manufacturing's going into recession there. Services barely holding up, and certainly very low by historical standards and well down from where they used to be in terms of activity. And also similar stories, Europe, US, Australia, Canada a little bit. Higher inflation, causing central banks to probably over-tighten. They will continue to over-tighten, and that will just really bring things down on the consumer and small and medium-sized businesses to a point where everyone begins to retrench in their activity. And that's why I see or did foresee the US economic recession in this year. And I've been saying 2023, the US will have either a recession or a depression. And what did we see yesterday? We've seen, well, in the last couple of weeks, we've seen Michael Berry, the famous Michael Berry, has joined my view about 6 months after I established it. And also the CEO of Goldman Sachs was very active in New York yesterday, saying how the US economy is probably going to have a hard landing, a recession in 2023. Nice to see these people joining the Clifford Bennett ACY view. Belatedly, but they are catching up. I make this point because often when I give my views, people go, oh, no, but so-and-so's saying this, so-and-so's saying that. Well, we tend to be ahead of the pack because we think for ourselves. We apply common sense to the real world. We look out the window and we assess for ourselves. And I suggest you do the same. All the big institutions, doesn't matter if it's Goldman Sachs, BlackRock, and they're well down this year, all the big institutions make all their decisions by committee. And John Maynard Keynes, many decades ago, said trading by committee is a sure path to failure. So I've always listened to those words from John Maynard Keynes, one of the world's most famous economists, and I do think it's very relevant today, just as it was back then. As an individual investor, you are empowered by the trading platform and the news services we have access today to have similar information. It won't be quite the same, but similar information and the pretty much same speed of possibility of response. But when we react to things or when we foresee things, we can be bold in our actions and our activity in a way that the big institutions simply can't, because everyone in the institution is worried about the internal politics. Should they say anything risky or do a risky trade, that someone in the internal politics will bring them undone, or it won't look good for the organization as a whole. And really, these people are far more interested, and I include all the big institutional economists there, and I was one of them once with BNP Paribas. All of the institutional economists, they all want to keep their jobs. That's their number one priority. Their number one priority is not getting the future right. Their job is the research divisions in large institutions is simply the marketing and advertising of the firm. Whereas in the small and medium-sized institutions, we're actually trying to get it right because we have to compete. So that's the difference. So, because I've had a lot of people say to me, oh, but, it was on the news, or, Goldman Sachs said, or Westpac said. Westpac's a good institution, by the way. But really take everyone's ideas into your own consideration, into your own spectrum of thought. I try to sort of stretch that spectrum sometimes, but come up with your own approach to how you see the world now, and then look for price action movements that encourage that view. And if it's a different view, good on you to the mainstream, because the biggest money is to be made when the market, the mainstream, the bulk of all market participants is wrong. And that's usually whatever the biggest institutions are thinking. So, little trading tips for today on the economic front. As I said recently, the run of economic data has been negative pretty much on every front except employment. That's both in the US and Australia, which means that interest rates keep going up as the economy begins to falter, hence the recession forecast for next year, which some of the big institutions are now beginning to join us on. On the day, stocks have come off. Now, that big rally has been largely undone. And so stocks have fallen back, and a lot of traders are out there going, okay, it's an opportunity to get long again. Problem is, a lot of the people who bought previously and drove the market up, they've suffered losses perhaps on the way down, or they don't need to buy anymore. So we're back near similar levels without a need to buy as much as was previously the case when we were here last time. That's why I think the market could still be vulnerable to further downside. Expect some kind of bounce, relief rally, but a modest one. And overall, after a few hours or a few days consolidation around current levels, the market can tip over the edge to the downside in a relatively big way at any point in time, really. So do keep your eye on US and Australian stocks in particular, and also the European stock market as well. Have a great day. Thank you very much.